Hello, welcome to the latest series of portfolio briefings where we look at the impact of COVID-19 on pension funds. With us today, I've got Barry Kenneth and I'm Mona Dole, the Deputy Editor of Portfolio Institutional. Barry is the CIO of the Pension Protection Fund, and we're going to be speaking to him today about the impact of COVID-19 on the PPF. So welcome, Barry. Thanks for joining us today.
Good afternoon.
Hi, good afternoon. It's good to speak to you. How are you today? How are you managing operationally with working from home?
Yeah, I guess we've been working from home now for about 4 weeks. I think our IT department did a great job in terms of being able to set everybody up from home with their Bloombergs, their trading systems, some of the analytical tools. So I guess from a practical perspective, we have most things that we could have at home to help soften the blow, if that's the right terminology. I guess the one thing that becomes slightly more challenging is that the team sit in one office, and I like to be able to interact with people face to face on a daily basis. I think it helps in decision making and also keeping everyone together and focused on the same outcome, and being able to hear different voices. And you don't have to plan meetings or calls or whatever in order just to go and talk to somebody about some of the issues. But in general, it's working as well as it could do. So I can't complain too much, and we're managing the portfolio pretty efficiently from home, I guess.
Yeah, that's actually interesting. A lot of companies will now have to reconsider actually that there might be a solution for the longer term, and something that I hadn't thought about before, how many more people can actually work from home.
Yeah, I guess I'm a bit old school. I'm not one that prefers to work from home. Much prefer an environment whereby you can interact with people. I think you get a different perspective on looking at markets and things, and But I guess we're in strange times.
We are indeed, and you must be in a bit of a peculiar situation in a way as a pension protection fund. I can imagine a lot of companies are currently assessing a lot of sponsors if they can sustain their pension schemes, and you might be facing quite a busy time actually. Do you think that there will be an uptake in demand of DB schemes joining the PPF as a result of the crisis?
I think it's interesting. I guess if the government and the central bank hadn't come in for support, then I guess that makes the whole of industry, or the UK industry, a bit more vulnerable. I guess the extraordinary support that we've seen from the central banks and the government have at least provided finance and money for workers in order to try and keep, I guess, good companies running. So I guess the interesting challenge and thought process now is how long we'll be locked down, how long is industry going to effectively stay closed, and what does the operating environment look like when we eventually or hopefully come out of this pandemic? Because it's very clear to me that the operating model of economies will be very different coming out of it than would have been going into it.
Yeah. So if you would see an increase in demand for schemes joining the PPF, how would you manage that on an operational level? Would there be a challenge?
Onboarding any set of assets is always an element of a challenge. What I would say is when I joined the PPF, I guess about maybe slightly more than that, 6.5 years ago, I think the assets under management at that time were less than 10 billion. And the assets under management now are probably north of 35 billion. So we've been on a growth spurt for the last 6 or 7 years. So I think our model and our process is very much set up that if we were to assume a bunch of assets in relatively short order, I think our proposition is scalable. So that's not something that overly worries me from a operational perspective. And I guess the other aspect of that is that when schemes or when corporates do become insolvent and the schemes go into the assessment period, it generally takes 1 to 2 years before these schemes actually hit our controlled assets. So we plan from the minute of, we tend to plan before insolvency. if it's a scheme that's on our radar, and generally in that assessment period we work very closely with the trustees in order to try and evolve the shape of the assets into something mimicking what our investment portfolio runs. So it's not a company goes insolvent and suddenly the pension scheme assets hit my account T+2. It's not quite as quick as that. So we do have some time to plan around these eventualities. So I think our proposition is scalable. So I don't worry too much about that.
Would it be a staged process in a way that you transfer the most liquid assets first, and then the less liquid ones like real estate?
No. I mean, effectively, the assessment period is where I guess a couple of big things happen in that assessment period. One, the data is all cleaned to make sure we understand exactly what we'd be taking on, and like some schemes are better funded than PPF levels, or very close to being that, and it gives them the opportunity to try and seek the insurance solution, i.e. they might not need us. But in terms of cleaning up the data, looking at the compensation payments going forward, and that whole kind of operational nightmare, if you want to call it that, or operational, in-depth operational stuff, that happens outside my team, and we do have an element of time in which to plan for when the assets do come in and what we're going to do with them. But the assets, when they do come into the investment process, they come in all at the same time. So, or each individual scheme will come in all at the same time, and we will figure out beforehand whether we need to transition the assets out, or we just assume the assets because we're quite happy to run them the way that in terms of the assets that the other scheme had, whether that fits into our investment process.
Okay, and in terms of your most recent asset allocation strategy, if we look a bit more in detail about that, you had about 40% of your and another 41% of the assets predominantly in bonds, as I understand it. How was that played out in the current crisis?
Well, I guess if you look at our portfolio on a very simplistic basis, we have 40% government bonds which back our LDI program, and we use both physical and non-physical instruments in order to manage the interest rate and inflation risk on our liabilities. So you can almost put that as one side of the balance sheet and say that 40% of our assets are used to manage that liability risk, and the other 60% of our assets are in predominantly return-seeking assets. I wouldn't say that most of these assets are in bonds. I think that in terms of the assets that are there to seek returns, I would say that probably at least half these assets, if not more than half these assets, are in non-bond instruments. So the reason we look as though we've got a high bond allocation is predominantly because we have 40% of government bonds back in the LDI program. But we have most asset classes. We'll have private equity, real estate, timberland, farmland, agriculture, listed equities, private equity. So we have all the asset classes outside bond-like instruments.
Okay, interesting. And with the LDI outlook, I mean, I'd be interested as well if you see a risk of inflation possibly picking up, in which case it might be quite good to have such a significant LDI allocation.
Look, I guess one train of thought is with all the extraordinary stimulus that's coming by the governments and the central banks, should that result in an increase in inflation? Look, I guess there's definitely a theory that would suggest that is likely to happen. How quick that happens is a real question. But I think there's a number of questions: how we come out the other side. Will demand be the same? Because the only way you're going to start getting real inflation is if the economy goes into overdrive and productivity is high and demand's high. It can't just be a supply side boost. It's got to be a demand side boost, and I guess at this moment in time, that is one potential way that we will exit this this pandemic. But it's no means certain that I think we'll end up with huge inflation. And I guess as far as the PPF is concerned, we have caps and floors on the inflation protection that we give to our members, so we're not totally exposed to retail price index or the consumer price index. But we have an element of that, yes, and it definitely is something that's more likely to affect our assets than our liabilities, I think.
Yeah. And are you considering any changes to your asset allocation?
Yeah, I mean, I think we look at our asset allocation all the time. I think ahead of coming into this pandemic that we effectively put lots of protection in our portfolio over the last 12 or 18 months. Not necessarily, not because of this eventuality, but more because obviously we had Brexit in the UK. We have asset prices that effectively were in normal times would be scream and sell, and we effectively de-risked part of our portfolio well in advance of the pandemic. So we've been running overweight cash, for instance, for quite a long period of time. We put in our listed equity portfolio, which is an active portfolio, we allocated 20% of that into absolute return, so we could take the beta down of the equity portfolio, but remain having active management there in terms of trying to generate from there. We classify it as our held portfolio, which is effectively our UK credit portfolio, but it doesn't just have corporate bonds in there. We'll have things like long lease property, ground rents, some structured notes, some loans, and that portfolio, we've enhanced the rating of that portfolio over the last 12 to 18 months. So if you look at the corporate bond, if you take something like, I guess, Barclays Global Ag, you'll have a kind of BBB to BBB plus type average rating, whereby the average rating in our credit portfolio is more like A-. So we've added elements of protection into the portfolio the last 12 to 18 months as markets have gone higher. And I guess that stood us in good stead through this pandemic. But I wouldn't profess to say that that we foresaw what was coming and the extent of what was coming. We've just been, because of our funding levels, it's relatively high. We've come at this from a position of strength, so we thought that it was sensible to kind of de-risk elements of the strategy as markets, in our view, became fundamentally expensive.
And with market values now, actually market valuations falling down quite a lot, there's some people now argue it might actually be a good time to get back into the markets and to start investing in certain pockets of the equity market again, for example, or even high yield bonds. Would you agree with that? Are there buying opportunities around now, or is it the case?
I mean, there are. I mean, we've allocated capital within the most difficult times here. But from a personal perspective, I see more value in the credit markets than I do in the equity markets. Reason being is that obviously the credit markets widened as well as the equity markets fell, and if you look at the stimulus that the governments and the central banks have targeted, so the central banks firstly targeted the interest rate market to try and control the yield curve, and then they've come in to try and then the other element of the stimulus is to come in and effectively protect the cash flow and balance sheets of corporates, and they've done that vis-a-vis buying debt. And I can see real reasons why that would underwrite credit from a fundamental perspective, because you now have a buyer at any price effectively into the credit markets. I'm not quite sure how that. I'm not quite sure how that filters into the equity market as much as the rebound that we've seen, I guess. I mean, even if you look at something like the S&P 500, that we were getting close to 3,000. I can't remember. I kind of fiddle out day by day here, but we got there certainly over the last 4 or 5 days. And if you look at S&P at 3,000, you're effectively saying that forward earnings are more than 20 times 2019 and what 2019's earnings were. And if that's how you think about it, there's a lot of challenges that we've got moving forward, and it doesn't seem that that's a screaming buy, whereby if you've got corporate spreads in the US trading at 300 or 350, and you have and you effectively have an infinite buyer being the government and the central banks, then that seems to me like a better risk reward than equity markets at the moment. So we certainly at the end of March we certainly deployed more money into credit, but we haven't deployed more incremental money into equities.
Okay, interesting. But that seems to be purely driven by central bank action. It's not really underlying assets.
Oh no. Because look, I mean, if you look at any time that credit spreads in March moved out to a level whereby before the central bank action, whereby they were quite extreme because cash was king. I mean, if you go back to 2008, which is obviously was another difficult time in markets, it ended up being cash is king, and it was almost a repeat of that, whereby retail investors and some institutional investors were almost selling at any price. And I think that at that point in time, that if you look at, very robust companies with strong balance sheets and strong cash flow and access to liquidity, there was no differentiation in the first leg down in markets to sectors and industries and companies, and we deployed some money into credit at that point in time to go to the top. We were effectively getting high yield spreads for investment grade companies that you would classify as very strong, balance sheet strong, demand strong, and so we were very selective about where money was placed. But it wasn't into high yield. It wasn't into the lower part of the capital structure. It was more at the higher end, top end, whereby we had plenty of protection in there. So we managed to maneuver some money into that. And
they were previously they were actually investment grade, but currently like kind of at high yield levels.
Yeah, I mean, the investment grade credit spreads were out beyond 350 at one point in time. So you don't have to go back too long where high yield wasn't trading that far, that much further wider than that. So on a risk reward perspective, look, don't get me wrong, it feels difficult anytime when you've got a market in free fall to go and deploy capital, but we chose not to rebalance into equities as the market fell, and we chose to rebalance into credit. So well, not all of it, but we did have an element whereby we put more money into credit, and again, I mean, it's worked out okay thus far, and I do think that there's an awful lot of challenges economically that we're going to have as we come out this. As much as the market reacted to the stimulus that came in from the central banks and the governments, I still think there is material challenges for companies and earnings growth going forward. And I feel more comfortable being in more in credit at this point in time as we come out of this. I mean, clearly we have the ability to change that as we maneuver forward.
Yeah, but what would happen if the current, I mean, we've seen concerns about short-term liquidity in credit markets. What happens if that translates in actually solvency problems of companies? Because I mean, this crisis, unlike 2008, is rooted very much in the real economy. So is a risk of firms actually going bankrupt, which is much more imminent than it was perhaps 12 years ago.
Sure.
Are you concerned about
that? Yes, I mean, clearly we're concerned about all of our investments, but if I'm concerned about bankruptcy, I'd rather be in the credit than the equity. So yes, no, of course, but we where we manage money internally, we're managing it at the higher end of the capital structure, and I think that the stimulus that's been put in there by government should relatively protect these companies. Yeah, they might have additional leverage as they move out of this, but as long as they've got cash flow and we choose industries that have got, we expect to have good demand going forward, then we should be okay. I guess in the equity market, that's one whereby I think that can go either way. Clearly, if we come out of this and we end lockdown in the not too distant future, and the demand side of the economy picks up very quickly, and we do end up in a kind of turbocharged economy, given the amount of extraordinary stimulus that have come into the economy, then you may well want to be in the equity. I just don't think that we are paid enough to go overweight equity here. I mean, we still have equities. We're just slightly underweight our benchmark. And it's not that I don't believe that equities will go up. I just want to see a little bit more evidence that the amount of challenges that we've got in the near term dissipate, and we see a road towards equity returns. Now, I think that if you look at the S&P, I mean, I think somewhere between 2,600 and 2,800 kind of makes sense to me, but 3,000 plus doesn't really at this moment in time until we get a bit more confidence.
Yeah. I was going to ask you about liquidity in bond markets as well. It's actually quite interesting if institutional investors like the PPF are entering at this point, like at the end of March, for example, to buy corporate bonds. As you said, we're suddenly quite attractively priced. Can the institutional investors now start playing a role in maybe offsetting some of the swings in liquidity or in volatility that we've seen at that time, at the end of March?
Yeah, look, I think in market functionality, clearly was a big problem in March, but market functionality has been a problem periodically since 2008. As an ex-banker myself, I mean, I was a banker for a lot longer than I've been a CIO, and post 2008, when I run the fixed income area at Morgan Stanley, we knew that banks had to pull back from offering, banks pull back capital and offering underwrites for markets, so the market functionality effectively changed then. And I think there's been periods since 2009 whereby markets have jammed up, and the functionality is the intermediaries when you get into stress times to sell, whether it be equities or credit or bonds or whatever. I mean, we've had a couple of times even in the most liquid market in the world, which is the treasury market, whereby it's been very difficult to trade small amounts in the treasury market when the market's at extreme. And I think all you have to look at is some of the things that have happened over the last 4 to 6 weeks, which are, and it's one of the reasons why actually we have quite a high cash allocation now. But if you look at what's happened, you've had things like WTI in the commodity market trading at -40. So basically you're paid $40 to buy to be delivered a barrel of oil, and the oil market's never traded below zero again before. You look at things like some of the daily swings in the equity market that you've never seen before. You look at the VIX up at 95. I don't think the VIX has been 95 since the Great Depression. So I mean, there's lots of news that we're having here, and part of the reason we are getting these news is the market intermediaries who would used to provide the balancer there haven't been there to provide the balance. So that's the reason why I think you've had more extreme moves than you would generally have had prior to 2008.
So you're referring to banks, the traditional players retreating from
Yeah, I'm talking about broker dealers, people that come in and effectively provide their own capital in order to provide a buffer to markets. Yeah. And what you see these days is that the minute the markets get volatile, the banks don't want to put risk capital to work.
Yeah. Interesting. So it's in a way the incentives are very different, and they're acting more like, in a way, not counter-cyclical. Like there's not really that client relationship anymore as well to like maybe offset the risk or take on a bit more risk on board. And instead, it's more.
They almost act like brokers now rather than intermediaries, whereby they can take balance sheet risk. So they act more like brokers. And like in good times, they will provide risk capital in functional markets to intermediate. But I think when things become very stressed and markets become extremely volatile, I think that their propensity to take on risk is a lot less than it would normally be.
Yeah, it's interesting talking to you about it because you can in a way see it from both sides because of your background, as you mentioned.
Yeah.
So that's really interesting. But it's also interesting to see that the PPF in that situation kind of capitalizes a bit on the situation, you could say, because you were holding more cash at the time, and what we invest. That's an interesting point. Coming to another topic, you also have quite a lot of alternatives in your portfolio. Would you say offset to some degree some of the volatility that we've seen?
I'm not sure offset. I mean, as you know, the valuations in private markets aren't quite as real time as valuations in public markets. that doesn't mean that the prices haven't moved. It just means that you haven't been reported on the prices that have moved. So,
Yeah.
look, I guess there's certain things in a private market portfolio which are not linked to the global GDP. So,
Yeah.
if you look at things like, I don't know, PPP infrastructure, or you look at
Mm.
farmland, timberland, agriculture,
Mm.
they're not traditional investments that will correlate directly with the equity market and credit markets.
Mm-hmm.
But if we have obviously we've got a private equity portfolio. I mean, the private equity portfolio, you'd expect that to act very similarly to the equity market portfolio, albeit you might not get the end of March mark until, I don't know, May, June, but the mark should still come through. It might be that the private markets mark to model a little bit more than mark to market, but I mean, ultimately, if the risk asset markets fall in general, if you've got something that's linked to GDP or the economies, then by definition, at some point in time, you should get a remark in these assets. It might not be as big peak to trough as listed markets on a daily basis, and you might get some averaging in there, but ultimately they should still be the same through time. They should have the same market impact. I don't buy the fact that the private market assets necessarily protect you more. If they've got a different risk profile, that's different.
What they've been sold as, you could say, though. No, that's what a lot of people see as a reason to diversify their portfolio in a way. Yeah.
I guess I'm a bit more of a realist than than an opportunistic when it comes to this kind of stuff. But look, don't get me wrong. I mean, there are certain private market assets that shouldn't act the same way as credit and equities, but that is a diversification across asset type as opposed to. I mean, if you're in private equity, for instance, and you are providing equity to companies, so that's no different than providing equity through listed markets. It's just the fact that it doesn't mark as often, and maybe you get some more operational improvements out of the GPs that manage that money. But if demand goes down the toilet for companies in a certain sector, whether it's private or public, they should both have an impact.
Yeah. So if we look at the bigger picture across all asset classes, where do you see the key risks for institutional investors at the moment?
I guess if I look big picture, I think that you can throw away a lot of the models. I think people that wed themselves to models and how this thing's going to play out. I think experience, market intuition, being able to be nimble and forward thinking, I think is going to be quite important as we come out of this crisis, because I don't think anybody knows how we're going to come out of it. Looking at recessions that have been caused by banking events like 2008, or have been caused by the economy overheating or a change in government policy, you have a playbook how that's likely to end up. I don't think you've got as much of a playbook how this is going to end up, because it's going to end up in a very, very deep recession. Whether it's V-shaped, U-shaped, or L-shaped, or someone said to me a swimming pool shape, which I guess is a bit strange. Yeah, well, maybe the U lasts for longer. I'm not quite sure. I think that it's very uncertain how we're going to come out of this. The one thing that I do know is we're going to have a lot more unemployed people. There's not going to be just one day where everything's going to go back to normal. And I guess we're relying very heavily on the medical science about how we come out of this, rather than economists and strategists and governments, because this is something that we haven't seen before in the developed economy. Yes, we saw Spanish flu in 1913 or 17 or whatever it may be, but we haven't had the kind of pandemic in a developed long-term market before, and we have to be slightly cautious, which we are, in terms of how we come out of this. But when we have milestones that we look at, and we've got certain triggers that we're looking at to get more confident that we can be a bit more aggressive if that's the way we want to be. But we're certainly not running to go and buy the equity market here or go overweight in risk assets, because we're still, I guess 10 to 15% below where we were in the start of March. I mean, there's a good reason for it. And
Probably not the only one, presumably.
Yeah, and I think the difference is, should we be 15% lower, 30% lower, 5% lower, 40% lower? It's difficult to know, right? But what we have to do here is use our risk management process. I mean, I don't know if you understand the PPF asset allocation, but very risk management focused. So when we make decisions, we take it with risk in mind, and so we're very deliberate in how we allocate money. We're very deliberate in what risks we're taking. And we don't think this is just as asset only. We have to look at our balance sheet and our funding level and make sure that when we are deploying money, that we think it's money good, and we think we're going to get the returns that we expect.
Yeah. So with that in mind, you mentioned milestones earlier. You had the long-term target of being financially self-sufficient by 2030. Are you thinking you're still going to get there? Are you going to reconsider that target?
I mean, I think at this stage, I don't think there's any. I don't think we've looked to change anything, or we've been talking about changing 2030. Look, 2030 was a date that was chosen before my time with PPF, I guess, in 2010. When 2030 was a long way away. What I can say is that our balance sheet is very robust. I think lots of pension funds would be very happy to be in the funding position that we're in. That's not to say that we didn't take some hits and risky asset markets in March, because we did, like everybody else did. But we have a very strong risk management thesis. We're very well funded. We're very much set up that no matter what the market event is that we can react to that, and the balance sheet is protected. And so we don't have the volatility swings in the funding level that others would have that are going for higher levels of return than us. So I feel pretty good about where the portfolio is at, and how we're set from a framework perspective. I think our risk management's strong, so we're not making bets on things that we don't understand what the risk against them. So look, as we come out this, if you're asking what would make me change our view on markets or asset allocation, look, there's assets I think that are better value than others. I mean, I think I mentioned it earlier on the call. I think credit's a better asset than equity just now. It might be in a couple of months' time that we can reach some of the I guess some of the analytics that we look at equities, we may take a different view. And I just think there's a lot of challenges just now, and being at the senior part capital structures, being slightly defensive until we get a bit more confidence, making sure that any money we put to work now is robust given the environment. And I think that when we get a bit more confidence that the way that we'll come out of this pandemic is a bit more certain, then I think we can be a bit more confident that if we put money to work in lower down the capital structure, that we can be confident that money will be put to good use. And I don't think anybody knows at this point in time about how we're going to end up and how economies are going to end up. And so, but people have got a view, and our view is that I think at the moment I'd rather be slightly cautious. We're not massively cautious, we're slightly cautious. We're on overweight cash, we're on overweight government bonds, probably overweight a little bit credit, slightly underweight in equities. But if we reach one of our milestones next week, we might change that. So what we have, the good thing about the PPF and the way we're set up now is because we manage over half the assets internally, we can react an awful lot quicker to market changes and be able to either protect more or take on more risk or whatever it may be, because we've got a fully functional in-house team that can take advantage of opportunities.
Okay, well, that's an interesting point as well. So it's quite cautious outlook on the global economy, but cautiously optimistic, you could say, about the situation for the PPF for the next 10 years.
Correct. Yeah. And look, if we have to amend the time, look, I don't think there's anything personally. I don't think there's anything particularly special about 2030. But look, if it turns out that the economy ends up being worse than you expect, and a lot more corporates come into the PPF, that's not something. I mean, we model it, we look at it, and if we end up having more claims than we expect, then I think our balance sheet is strong enough to handle that. But if it means that it's 2031 rather than 2030 or 2029, I mean, I think the most important thing is the PPF is financially robust. We've got strong reserves and we've got a strong risk management focus and process and how we manage an investment. So I'm pretty confident that we're in a pretty strong place. We're in a very strong place, and hopefully through our investment process, investment framework, and how we assess and interact with companies that are in trouble, I think we're in as good a position as we possibly can be.
Well, that's reassuring to hear. Thank you very much, Barry.
Okay, thank you very much for your time.
Thank you.
Bye.